The most dangerous systemic risks in the global economy never make the evening news until it is entirely too late. Right now, retail investors are staring at the stock market. They are watching the S&P 500. They are dissecting the latest remarks from the Federal Reserve, arguing over interest rate cuts, and convinced that the banking crisis of 2023 was fully contained. They believe the system is stable. But behind closed doors, in the boardrooms of the world's largest alternative asset managers, a massive, predatory operation is currently underway. The smartest money on Wall Street is not celebrating a soft landing. They are quietly stockpiling hundreds of billions of dollars in dry powder, preparing to feast on the largest commercial real estate collapse since 2008. Welcome to the Institutional View. Today, we are pulling back the curtain on the shadow banking system. We are going to decode a silent, $1.5 trillion crisis that is currently eroding the foundation of the American regional banking sector. More importantly, we are going to reveal the exact mechanism institutional capital is using to profit from this collapse. It is a sector called private credit. And if you do not understand how it works, you will be left holding the bag when the public markets finally wake up to the math. First, we must look at the trap that has been set in plain sight. The public narrative is that commercial real estate is struggling because people work from home. That is only a fraction of the truth. The real issue is the debt maturity wall. Over the next 36 months, roughly $1.5 trillion of commercial real estate loans will come due. These loans were originated years ago in a 0% interest rate environment. The developers and the property groups secured capital at 2 or 3%. Today, the macroeconomic reality has completely fractured. Those properties are sitting half empty, generating a fraction of their projected revenue. But the real catastrophe is that those loans cannot be refinanced at 2%. They must be refinanced at today's rates, at 7, 8, or 9%. For the vast majority of these properties, the math no longer works. The asset simply does not generate enough cash flow to cover the new cost of capital. In institutional finance, we call this an underwater asset. In plain English, it is a guaranteed default. But here is the critical data point the retail market is ignoring. Who holds this debt? It is not the megabanks. JP Morgan, Bank of America, and Goldman Sachs offloaded the majority of their risky commercial real estate exposure years ago. The entities holding the bag are the regional banks. Small to mid-sized banks currently hold nearly 70% of all commercial real estate loans in the United States. These banks are terrified. They cannot afford to foreclose on hundreds of massive office buildings and shopping centers. If they take those properties onto their balance sheets, they have to mark them to market. They have to admit that a building they loaned $100 million against is now only worth $40 million. If they admit that, their Tier 1 capital evaporates. They become instantly insolvent. So, they play a game called extend and pretend. They offer short-term extensions on the loans, hoping the Federal Reserve drops interest rates back to zero before the music stops. But the institutions know the music has already stopped. And this is where the smart money enters the bloodbath. While the regional banks are paralyzed by toxic debt, the apex predators of global finance have evolved. Enter the era of private credit. Private credit is essentially non-bank lending. It is Wall Street giants like Blackstone, Apollo, and Ares Management stepping in to act as shadow banks. Over the last 2 years, these alternative asset managers have raised over $1 trillion from sovereign wealth funds, pension funds, and ultra-high net worth individuals. They are not using this money to buy stocks. They are using this money to become the lender of last resort. When a commercial real estate developer realizes their regional bank will no longer refinance their property, they have to turn to the shadow banking system. And the private credit funds are waiting for them. But institutional capital does not offer bailouts out of the kindness of their hearts. They offer predatory rescue capital. The private credit funds will write the check to save the building, but they demand absolute dominance over the capital structure. They demand double-digit interest rates. They demand equity kickers. They demand bulletproof collateral. They are engineering loans where, if the property developer ultimately fails, the private credit fund takes ownership of a prime real estate asset for pennies on the dollar. It is a perfectly constructed asymmetric trap. Heads, the institution gets a guaranteed 12 to 15% yield. Tails, they seize the physical asset at a massive discount. The retail investor is completely blind to this ecosystem. Private credit operates entirely off the public exchanges. It is an opaque, unregulated market where billionaires dictate the terms to desperate borrowers. But as an aspirational investor, you can track the footprints of this capital shift. You just have to know which public entities control the private markets. This brings us to the geo-arbitrage and institutional pivot. As regional banks pull back from lending, not just in real estate, but in corporate financing, private credit is filling the void across the entire global economy. Major tech companies, industrial conglomerates, and infrastructure projects are increasingly bypassing the traditional banking system entirely. They are going directly to the private credit markets. This means the traditional banking sector, the sector retail investors blindly buy through financial ETFs, is structurally shrinking in power and profitability. The regional banks are becoming zombie entities, trapped under the weight of their own commercial real estate bad debt. So, how do you position yourself? How do you adapt to a market where the real lending is happening in the shadows? First, you must deeply audit your exposure to the traditional banking sector. The regional bank ETFs may look like deep value plays, they may offer attractive dividend yields, but you must understand that those dividends are being paid out on borrowed time. You do not want to hold the equity of a bank that is hiding a 50% loss on its commercial loan portfolio. Second, look at the architects of the private credit boom. The massive alternative asset managers that govern the shadow banking system are publicly traded entities. You can buy the stock of the companies that are writing these predatory loans. You can align your capital with the entities that are currently holding the regional banking sector by the throat. When you buy shares in top-tier alternative asset managers, you are effectively buying a slice of their management fees and their performance fees across hundreds of billions of dollars in private credit deployment. You are getting paid to watch them strip the meat off the bone of the commercial real estate crisis. Third, recognize the macroeconomic shift. We are entering an era of capital scarcity. For the last 15 years, money was free. Anyone could borrow. Anyone could build. That era is over. The cost of capital is fundamentally higher. In an environment of capital scarcity, the entity with the cash makes the rules. The private credit funds have the cash. The market is a machine. It does not care about your assumptions. It does not care that a building used to be worth $100 million. It only cares about cash flow and liquidity. The $1.5 trillion commercial real estate wall is not a theory. It is a mathematical certainty. And the wealth transfer from the regional banks to the private credit sector has already begun. This is the institutional view. Do not be distracted by the daily fluctuations of the stock market. Watch the debt. Watch the shadow banks. And align your capital with the entities that control the terms of survival. We will continue to dissect the private credit markets and the 13F filings as the defaults begin to cascade. If you want to maintain your institutional edge, make sure you are subscribed. Until next time, trade the reality, not the narrative. When a predator isolates its prey, the actual kill is rarely immediate. It is methodical. It is a process of exhaustion. In Chapter 1, we exposed the $1.5 trillion debt maturity wall that is currently suffocating the American regional banking sector. We identified the apex predators, the massive alternative asset managers and private credit funds that are stepping in to provide rescue capital to desperate real estate developers. But rescue capital is a deliberate misnomer. The institutions do not want to rescue the building. They want to own it. Welcome to Chapter 2. Today, We are breaking down the exact financial mechanics of the default cascade. We are going to decode a ruthless institutional strategy known as loan-to-own and explain exactly why the regional banks are completely powerless to stop it. If you are a retail investor holding regional bank stock or real estate investment trusts, you need to understand the math of how your equity is currently being zeroed out. Let us look at the anatomy of a shadow banking deal. Imagine a prime commercial office tower in the center of a major metropolitan city. 5 years ago, it was valued at $200 million. The developer took out a $150 million loan from a regional bank at an interest rate of 3%. Today, the building is half empty. The valuation has plummeted to $100 million. The regional bank loan has matured, and the bank is demanding to be paid back. But the developer does not have $150 million in cash. And no traditional bank on earth will refinance a failing office building at an 8% interest rate. The developer is trapped. They are days away from bankruptcy. Enter the private credit fund. The fund approaches the developer with a lifeline. They offer to pay off the regional bank and issue a new loan. But the terms of this new loan are deliberately toxic. The private credit fund demands a 15% interest rate. They demand senior secured status, meaning if anything goes wrong, they are the very first to be paid. And most importantly, they structure the debt using a mechanism called PIK. Payment in kind. Payment in kind means that if the developer cannot afford the massive monthly interest payments in cash, the unpaid interest is simply added to the total principal of the loan. The retail investor assumes this gives the developer breathing room. The institutional investor knows this is a death sentence. Because of the magic of compound interest, a 15% payment in kind loan acts like a financial tumor. It grows exponentially. Within 24 months, the developer owes far more than the building could ever possibly be worth. The developer officially defaults. And this is the exact moment the trap snaps shut. The private credit fund forecloses on the property. Because they hold the senior secured debt, they wipe out all of the other equity holders. They take complete legal ownership of a prime, Class A commercial office tower, effectively acquiring it for pennies on the dollar compared to its construction cost. This is the loan-to-own strategy. It is not lending. It is hostile acquisition masquerading as credit. The private credit funds have billions of dollars of dry powder sitting on the sidelines, specifically waiting to execute this maneuver across the entire country. They are waiting for the blood to flow in the streets so they can buy the streets. But what happens to the regional banks? The mainstream financial media will tell you that the Federal Reserve and the FDIC will step in to protect the banking system. They will point to the bailouts of Silicon Valley Bank and First Republic in 2023 as proof that the system is safe. This is a dangerous and mathematically flawed assumption. The FDIC insurance fund only covers a fraction of the total deposits in the American banking system. It is designed to handle isolated bank failures. It is absolutely incapable of handling a systemic, nationwide collapse of the regional banking sector driven by commercial real estate defaults. The Federal Reserve knows this. The Treasury knows this. So, what is the actual institutional endgame for the regional banks? Consolidation. The government will not bail out the shareholders of these small banks. Instead, they will broker forced marriages. As the commercial real estate losses eat through the Tier 1 capital of the regional banks, the regulators will quietly step in over the weekend. They will seize the failing regional bank, wipe out the retail shareholders to zero, and sell the bank's assets to a Wall Street titan like JP Morgan or Bank of America at a massive discount. The government even provides loss-sharing agreements to the megabanks, guaranteeing that if the commercial real estate loans go bad, the taxpayer absorbs the hit, not the megabank. It is the ultimate transfer of wealth. The regional banks are cannibalized. The retail shareholders are annihilated. The megabanks grow larger and more monopolistic. And the private credit funds seize the physical real estate. This is the brutal reality of the consolidation phase. And it is not restricted to commercial real estate. As the regional banks die, they stop lending to small and medium-sized businesses. The local manufacturing plant, the regional logistics company, the mid-sized healthcare provider, they can no longer walk into a local branch and secure a line of credit. Where do they go? They are forced into the shadow banking system. They are forced to take high-interest loans from the exact same private credit funds that are currently strip-mining the real estate market. Private credit is metastasizing. It is expanding beyond office buildings and shopping centers, and it is taking over the entire corporate debt structure of the global economy. The alternative asset managers are becoming more powerful than the traditional banks. They operate with far less regulatory oversight, they require far less capital reserves, and they dictate the terms of survival for thousands of corporations. But this centralization of power creates an entirely new systemic risk. A risk that transcends borders and brings us back to the ultimate macro-narrative of global capital flight. Because these shadow banks are not just lending in North America and Europe. They are aggressively moving their operations overseas. They are funding the exact geo-arbitrage infrastructure shifts we decoded in our previous series. They are taking the wealth extracted from the American real estate collapse and deploying it into the emerging markets. That is the final piece of the macro puzzle, the global sovereign pivot. And that is exactly what we will decode in Chapter 3. Do not be blinded by the illusion of FDIC insurance. Do not hold the equity of a dying regional bank. Watch the debt structure. If you want to maintain your institutional edge, make sure you are subscribed. Until next time, trade the reality, not the narrative. In global finance, capital acts like water. When you build a dam to restrict its flow in one area, it does not simply disappear. It builds pressure, it finds a crack, and it violently floods into a new, unregulated basin. In Chapter 1, we exposed how the shadow banking system is preparing to feast on the $1.5 trillion commercial real estate collapse. In Chapter 2, we detailed the ruthless mechanics of the loan-to-own strategy and the engineered death of the American regional banking sector. But the apex predators of global finance, the trillion-dollar alternative asset managers, do not limit their ambitions to domestic real estate. When you accumulate hundreds of billions of dollars in private credit, you outgrow the capacity of the Western markets. You begin to look for larger, more structural vulnerabilities. Welcome to Chapter 3, the conclusion of our thesis on the private credit time bomb. Today, we are decoding the sovereign pivot. We are tracking the shadow banking system as it leaves the West and begins to finance the massive infrastructure shifts of the emerging markets. If you want to understand how to protect your wealth during the coming consolidation, you must understand where the smart money is establishing its new strongholds. Let us return to the geo-arbitrage thesis. As we established in our previous series, there is a massive supply chain realignment occurring globally. Capital is fleeing the geopolitical tension of China and the regulatory red tape of the West. It is flooding into India, Malaysia, Vietnam, and Latin America to build the data centers, the manufacturing hubs, and the energy grids of the next decade. But building a multi-billion-dollar semiconductor plant in India or a deep-sea port in Vietnam requires massive, long-term financing. Historically, these projects were funded by the World Bank, the International Monetary Fund, or massive syndicates of global megabanks. But the era of traditional banking is ending. The megabanks are constrained by Basel III regulations. They are forced to hold massive capital reserves, making it incredibly expensive for them to issue complex, cross-border infrastructure loans. The traditional banks have stepped back, and the shadow banks have stepped in. Private credit funds are now directly negotiating with foreign governments. They are acting as sovereign lenders. When a developing nation needs to upgrade its power grid to support Western data centers, they no longer go to JP Morgan. They go to Apollo. They go to Ares Management. They go to Blackstone. The alternative asset managers are writing billion-dollar checks to fund the infrastructure of the East. But remember the mechanics of Chapter 2. Institutional capital does not offer charity. It offers predatory rescue capital. When a shadow bank finances a sovereign infrastructure project, they demand draconian collateral. They structure the debt so that if the developing nation defaults, the private credit fund takes physical ownership of the port, the toll roads, or the power grid. They are essentially executing the exact same loan-to-own strategy we see in American commercial real estate, but they are applying it to the critical infrastructure of sovereign nations. It is a new form of financial imperialism, and it operates entirely outside the oversight of the Federal Reserve or the European Central Bank. So, we have established the perimeter of the trap. The regional banks are suffocating under domestic real estate debt. The megabanks are paralyzed by global regulations. And the shadow banking sector has seized control of both domestic corporate lending and international infrastructure financing. How does the omniscient investor extract alpha from this reality? How do you position your capital when the very nature of lending has fundamentally shifted into the dark? First, you must completely abandon the traditional financial sector as a safe haven. The retail market has been conditioned to believe that buying a regional banking ETF is a conservative, value investing strategy. It is not. It is catching a falling knife. You are buying the toxic debt that the smart money deliberately left behind. Second, you must recognize that the alternative asset managers are no longer just investment firms. They are the new global banking cartel. The companies that manage these massive private credit portfolios are publicly traded. You can buy their equity. When you own shares in the top-tier alternative asset managers, you are effectively aligning yourself with the house. You are purchasing a stream of management fees that are skimmed off the top of the global geo-arbitrage shift. You are getting paid when they seize an office building in Manhattan, and you are getting paid when they finance a power grid in Malaysia. Third, you must respect the era of capital scarcity. For the last 15 years, the stock market rewarded companies that burned cash to achieve growth. Because money was free, profitability did not matter. That game is over. When corporate debt is controlled by ruthless private credit funds charging double-digit interest rates, companies that burn cash will simply be foreclosed upon. They will be cannibalized. The only equities that will survive the coming decade are companies with fortress balance sheets. Companies that generate massive, sustainable free cash flow. Companies that never have to ask a shadow bank for a loan. The transition from a public, regulated banking system to a private, unregulated shadow system is the most profound macroeconomic shift of our generation. It will wipe out the middle-class commercial real estate developer. It will annihilate the regional bank shareholder. And it will transfer trillions of dollars of physical assets into the hands of a few elite alternative asset managers. The market is a machine. It has no morality. It only has mathematics. This is the institutional view. Stop watching the daily fluctuations of the S&P 500. Look beneath the surface. Track the debt. Align your capital with the entities that control the terms of survival and hold the cash flow producers that never have to beg for capital. We will continue to monitor the 13F filings, the sovereign debt markets, and the shadow banking ledgers as this crisis accelerates. If you want to maintain your institutional edge, make sure you are subscribed. Until next time, trade the reality, not the narrative.